Welcome to your daily solo 401k webinar and Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic is, can I contribute to a solo 401k for the previous year? So today's webinar is about one of the most misunderstood and most powerful solo 401k strategies out there. Yes, you may be able to put money in this year and count it for last year, but only if you understand a few make or break rules. What is more, you might still be able to make contributions for tax year 2025 and 2026 if you're listening to this webinar for the first time in tax year 2026. So if you are a little behind on your retirement planning, or you didn't realize how much you could contribute, or your tax bill this year is higher than you had hoped, this strategy may be a game changer. So most people think if the year is over, it's too late. But with the solo 401k, you often get a second chance, but only if you plan was set up in time and only if you follow the IRS timing rules exactly. So again, if you're listening to this webinar for the first time in year 2026, then this webinar is going to be beneficial to you. If you're listening to this webinar today for the first time because we're broadcasting it live, then this webinar will also be beneficial for you, because here we are in November of tax year 2025. Many individuals are looking to open a solo 401k plan for the first time. So you still have plenty of time to open the solo 401k by December 31st of 2025, so that you can make all contribution types next year in 2026, including employee contributions, employer contributions, and voluntary after-tax solo 401k contributions. If you wait to open the plan after 2025, so January 1st of 2026 and after, but by the business tax return due date plus timely filed extension, depending on your self-employed entity type, you may be able to still make all three contribution types, or if your business is taxed as a sole proprietorship, then you would be able to make all contribution types as long as you open and fund a plan by April 15 of 2026. You can make employee, employer, and voluntary after-tax contributions for tax year 2025. At minimum, you would have to make that employee contribution by April 15 of 2026 for tax year 2025. If you wait to both fund and open the solo 401k plan by April 15 of 2026, if your business is taxed as a sole proprietorship. If it's taxed as an S corp or partnership, and you wait to open the solo 401k on January 1st or after of 2026, but by the business tax return due date plus timely filed extension, you would not be able to make employee contributions, but you would be able to make both employer contributions and voluntary after-tax solo 401k contributions for tax year 2025. So we're going to discuss all of that today. So in today's session, we're going to break down step by step what types of solo 401k contributions can be made for the prior year, because again, not all contributions are treated the same. So this is your chance to get answers. Use the chat to ask questions on today's topic or anything else. Type them over now so that we can be sure to get to them all. Let's continue. So of course, before you can even open a solo 401k plan, you want to make sure that you are eligible to open a plan. A solo 401k plan, just like the word solo implies, is for business owners. So it's typically owner-only businesses that have one owner or multiple owners, or both spouses are working in the same business. However, your business cannot employ any non-owner full-time W-2 employees who work 1,000 hours or more in your business, or typically any of your businesses. So if you employ an individual who is not an owner, and if he or she is a W-2 employee, and if that employee works 1,000 hours or more in your business, you would not be able to open a solo 401k plan unless that individual is under age 21. You can always exclude those employees who are under age 21, regardless if they work 1,000 hours or more in your business. You can also exclude contractors in your business. Okay. So again, please type over any questions you might have during today's daily webinar. We'll make sure to get to those questions as they come in. Let's continue for now. So here are some of the things we're covering today. Employee deferrals for the prior year. So employee deferral is another way of saying employee contributions. In the context of a solo 401k, that's the $23,500 contribution limit for tax year 2025. So that's what employee deferrals, another way of saying employee deferrals. It's referring to it as employee contributions. So if you're looking to make employee contributions for tax year 2025, then there are different rules with regards to the deadlines. When we're talking about a sole proprietorship, self-employed business versus an S corp or partnership self-employed business. With the S corporation or an LLC taxed as an S corporation, the contributions will be based on your W-2 wages from that self-employed S corporation. Or if it's a partnership, it'll be based on Form 1065, Schedule 1 of your partnership. Now, with regards to a sole proprietorship, and if you're trying to make employee contributions for tax year 2025, and you have not yet opened your solo 401k plan, so you're looking to open your solo 401k plan and you understand that you are eligible because you're self-employed, then you need to open that solo 401k plan by April 15 of tax year 2026. And you also have to make that employee contribution by April 15 of 2026 for tax year 2025. If you wait to open that solo 401k plan until January 1st through April 15 of tax year 2026. Now, if you open the solo 401k plan here in 2025 by December 31st of 2025, then you're going to be able to make employee contributions all the way up until your business tax return due date next year. So April 15 of 2026, or if you file for an extension, you'll have until October 15 of tax year 2026 to make those employee contributions to the solo 401k. And again, we're talking about number one, employee contributions. Number two, a sole proprietorship or an LLC tax as a sole proprietorship. So to add to that, if you want to go ahead and open the plan here by December 31st of 2025, you still have plenty of time because you simply need to sign those plan documents by December 31st of 2025. By signing those plan documents, you can wait till your tax return due date plus timely filed extension in 2026 to both get the employer identification number for the solo 401k, open up the bank or brokerage accounts for the contribution and for the contributions, and then also make the contributions. So the December 31st solo 401k setup deadline can be met very easily by just simply signing the solo 401k plan documents by December 31st of 2025. Now, only the sole proprietorship has that exception where you can procrastinate, or if you forgot about it, it allows you to open that solo 401k by April 15 of 2026 so that you can still make employee contributions for tax year 2025 by April 15 of 2026. If you open it after April 15 of 2026, you won't be able to make any employee solo 401k, also known as salary deferral contributions. However, you will be able to make employer contributions and voluntary after-tax solo 401k contributions if you open the solo 401k plan after April 15 of 2026, but by October 15 of 2026, and also make that employer contribution and voluntary after-tax solo 401k contribution for October 15 that'll allow you to make those contributions for tax year 2025. Now let's talk about an S Corp as well as a partnership, or an LLC tax as a partnership, or an LLC tax as an S Corporation. For those, when we're talking about employee contributions, so salary deferral contributions, when your business is an S Corp or a partnership, you have to open that solo 401k plan by December 31st of 2025 in order to be able to make employee contributions to the solo 401k for tax year 2025. So again, you need to make sure you sign those plan documents by December 31st of tax year 2025 so that you can make employee contributions in 2025, or you can make them by March 15 or September 15 if you file a timely business tax return extension, whether it's an S corporation or a partnership, and you can make the employee contributions by March 5th. So you can make the employee contributions for tax year 2025 by March 15 of 2026 or September 15 of year 2026 for year 2025, provided that you set up that solo 401k plan by December 31st of this year, so 2025. If you wait till January 1st of 2026 and after, and you're looking to make tax year 2025 contributions, then you're going to need to make sure that you open that solo 401k plan, that is, sign the plan documents, open up the holding accounts, aka bank or brokerage accounts, and make the contributions by September 15 if you file a business tax return extension. However, you're only going to be able to make employer contributions and voluntary after-tax solo 401k contributions, not employee contributions, if the plan was not set up by December 31st of 2025. So those are things to be aware of. So we've already touched on this. Employer contributions and voluntary after-tax contributions have different deadlines than the employee contributions from a setup perspective, meaning those that are opening a solo 401k plan for the first time. So let's keep going over some information here. So again, we're talking about, can I contribute to a solo 401k for the previous year? We talked about the different rules for sole proprietorships, S corps, and partnerships. We talked about the deadlines: April 15, March 15, September 15, October 15, and the December 31st deadline. Now, a lot of these regulations are stemming from the passage of Secure Act 1.0 and Secure Act 2.0. Okay, so again, the employer profit sharing contributions, as well as the voluntary after-tax solo 401k contributions, are frequently allowed after year end if you open the solo 401k plan after year end. It's just that your employee contributions will be impacted unless your business is taxed as a sole proprietorship. So the deadlines depend, the contribution deadlines and the setup deadlines For a solo 401k, again, depend on whether your business is taxed as a sole proprietorship, S corp, or partnership. So we already went over this information here. We're going to go over this real life example in a minute, but let's take a look at this question here. If annual income from the S corp is 150,000, I want to make wages. I want to take wages and do contributions as follows. W-2 wages from the S corp of 23,000. Owner spouse each towards pre-tax, Roth, no employer contributions, pre-tax Roth, contribute through employer employed towards voluntary after tax, 47,000 each. Is this allowed? Has total contributions 140,000 less W-2. So it looks like you're looking to make some pre-tax contributions as well as some voluntary after-tax solo 401k contributions. Both of you, so you and your spouse are both self-employed in the same business tax as an S corporation. You don't employ any non-owner W-2 employees who work 1,000 hours or more. You do not contribute to another 401k, such as a daytime employer 401k. So, one, contributions to the solo 401k plan, whether they're employee, employer, or voluntary after tax contributions, they have to be based on your W-2 wages from your self employed business. So, you cannot contribute more than you make. And in order to contribute the overall limit for tax year 2025, you have to have the necessary W-2 wages. Now, here's an example of a two-participant plan. So assuming you and your spouse are both self-employed under the same S corporation, the solo 401k plan would be sponsored by the S corporation. So this slide here is an example of a two-participant plan. You notice here that it's just one plan, but there's a total of 6 holding accounts, also known as bank or brokerage accounts. And that's because you have two participants in the plan, number one. Number two, the regulations, that is the 401k regulations, require that each participant's funds are separately accounted for, that is tracked, as well as their respective source, solo 401k contribution sources, so fund sources. So in this example, there's a total of 6 brokerage accounts. So 3 for each participant. Each of those 3 brokerage accounts or bank accounts, aka holding accounts for the solo 401k, one is a pre-tax solo 401k brokerage account. The second one is a Roth solo 401k brokerage account. And the third one is a voluntary after-tax solo 401k brokerage account. So times 2, that's a total of 6 because you have 2 participants. Now, the plan allows for all these contribution types. So you're not opening up 6 solo 401k plans. It's just one plan that allows for all these source of contributions. What is more, you're not required to make all these contribution types to the solo 401k each year. Also, the plan that we provide here in my solo 401k financial is drafted for the maximum flexibility under the IRS regulations, which means that even though it allows for the mega backdoor Roth and therefore voluntary after-tax contributions as well as in-plan conversions or conversions to the Roth IRA, that doesn't mean that you have to utilize all these features right away, nor does it mean that if you don't utilize all these contribution features that you lose those options. No, that's all built into the plan. So it's already part of the plan, which you can utilize now or later. So in your situation, if you're each trying to make contributions to the solo 401k plan, based on 150,000 of W-2 wages, which means that each of you are going to have a separate W-2 from the self-employed S corporation business, because the contributions to the solo 401k plan are based on each spouse's separate W-2 from that S corporation self-employed business. So if, let's say that each of you pay yourself $150,000 of W-2 wages from that S corporation. So one option is you can make employer contributions, and then the difference after you make the employer contribution, you can make it as a voluntary after-tax solo 401k contribution. So for example, if I multiply $150,000 times 25%, because the employer contribution is always a percentage calculation. It's not a dollar for dollar calculation like the employee contribution and the voluntary after-tax contribution. That's one of the big differences between the employee contribution, and the voluntary after-tax contribution versus the employer contribution. Only the employer contribution is percentage based. So in the context of an S corporation, utilizing your example here, if you make 150,000 of W-2 wages, one scenario is you can contribute $37,500 as an employer pre-tax contribution. So you would deposit that into the pre-tax solo 401k bucket. And I got that amount by multiplying 25%, multiplying 150,000 by 25%. So now the overall contribution limit for tax year 2025 for someone who's under age 50 is $70,000. So then you would subtract that $37,500 from that $70,000. So minus 37,500. So now that equals $32,500. So after you deposit that $37,500 of employer contributions to the pre-tax solo 401k holding account, you can then contribute $32,500 in voluntary after-tax solo 401k contributions to the voluntary after-tax solo 401k holding account, and then immediately convert it to the Roth solo 401k or even to a Roth IRA. And I got that figure of 32,500 by first subtracting that employer contribution of 37,500 from $70,000, and that would be your maximum contribution. If your spouse also wants to do the same scenario, if your spouse pays herself $150,000, then she could do the same amounts, and that's how you would both end up and contributing a total of $70,000 each separately to the solo 401k. Excuse me. Now, a second scenario, you can choose to make employee contributions to the solo 401k. And then for tax year 2025, the maximum employee contribution for someone who's under age 50 is $23,500. So you would contribute $23,500 as a pre-tax solo 401k contribution if you want to get a tax deduction for the year, or you can contribute it directly to the Roth solo 401k, but you won't get a tax deduction. And then the difference up to $70,000, you can contribute as a voluntary after-tax solo 401k contribution. So 70,000 minus 23,500, that's a total of $46,500 that you can contribute to the voluntary after-tax solo 401k bucket. And then you can convert that to the Roth solo 401k or the Roth IRA. And now you've indirectly have contributed $70,000 into your Roth solo 401k. And that can be done also by your spouse, as long as your spouse also has enough W-2 wages from the self-employed business to support that contribution. A third example is you can say, I only want to make voluntary after-tax solo 401k contributions. And this might be especially the case for someone who's listening to this webinar for the first time in tax year 2026, where they may have missed the solo 401k setup deadline for tax year 2025, where they could make employee contributions. but they could still make voluntary after-tax solo 401k contributions for tax year 2025 if they set up the plan in tax year 2026 by their business tax return due date plus timely filed extension and make the contribution. So let's say it's an S corporation and the individual forgot to set up the plan in 2025. Well, if you're listening to this for the first time in tax year 2026, you still have time to open the solo 401k plan in 2026, as long as you open it by by September 15 of 2026, if it's an S corporation, and you would also have to make that voluntary after-tax solo 401k contribution by that September 15, 2026 deadline for tax year 2025. So you could contribute the entire $70,000 to the voluntary after-tax solo 401k and then convert it to the Roth solo 401k or the Roth IRA. So as you can see, you can split up that overall limit of $70,000 in a variety of ways between those three different source of funds, that is pre-tax, Roth, and voluntary after-tax. But there are different rules that come into play from whether you're opening the plan for the first time and the contribution type, as well as your self-employed entity type. All right, good question. Hopefully that answers your question. Let's see if we have some more questions here. Looks like we have a follow-up question. So sum of all contributions into the solo 401k pre-tax, Roth after-tax cannot exceed W-2 from employee side, and also employer contributions are limited to 25% if it goes into pre-tax solo 401k only. So bottom line is you can only contribute a total of $70,000. That's all you have to work with, whether you make it as an employee contribution, employer contribution, voluntary after-tax contribution, or a mixture. All right, great question. So let's go ahead and continue typing over your questions, and we'll go over those. We're talking about today's topic is, can I contribute to a solo 401k for the previous year? And this is especially an important webinar for those who listen to this for the first time in 2026. So if this information is helping you feel more confident about your future, please take 1 second to like and subscribe. It tells the platform this content is valuable, which helps other solopreneurs to more easily find it. Subscribing also guarantees you get notifications of all our crucial content that we deliver every day to help you secure your retirement. So we have a follow-up question here. So you can pay less W-2 wages yourself and contribute max solo 401k accounts? Well, you need to make sure you pay yourself enough W-2 wages in order to make contributions. For example, if you want to make a voluntary after-tax solo 401k contribution to the solo 401k plan for tax year 2025, you're going to need, and if your business is taxed as an S corporation, the minimum that you have to pay yourself is $70,000. Why? Because voluntary after-tax solo 401k contributions are calculated on a dollar-for-dollar basis, which means that if you pay yourself $70,000 and you only plan to make voluntary after-tax solo 401k contributions, you only need to pay yourself $70,000. You don't need to pay yourself any more than that if you're trying to make contributions, additional contributions to the plan, unless you're trying to make a catch-up contribution or a super catch-up contribution. But that would be if someone is age 50 or older in the case of a catch-up contribution, in which case you would have to pay yourself $77,500. If you're trying to make a super catch-up contribution because you're age 60, 61, 62, or 63, you would need to pay yourself $81,250. Now keep in mind that the catch-up contribution and the super catch-up contribution do not count towards your mega backdoor Roth. In other words, you cannot make normal catch-up or super catch-up contributions to your voluntary after-tax solo 401k. That's not allowed. The maximum you can utilize for the mega backdoor Roth and therefore to the voluntary after-tax solo 401k is the overall limit known as the 415 limit, which is $70,000 for tax year 2025. Okay, so let's see if we can find the example here that So let's go over this real life example here. So John earns 100,000 of self-employment income from his S corporation self-employed business. John sets up the solo 401k before year end, or by year end. So by December 31st of 2025, he signs the plan documents. That's all he needs to do is sign the plan documents. He doesn't need to set up the bank accounts, brokerage accounts, or make contributions in order to qualify to make contributions to the solo 401k plan in 2026 for tax year 2025. And it's very easy. You just need to sign the plan documents by then. So he's going to be able to make all contribution types to the solo 401k plan in tax year 2026 for his self-employed S corporation. Why? Because he signed the plan documents by December 31st of tax year 2025. So he's going to be able to make employee contributions, employer contributions, and voluntary after-tax solo 401k contributions, which may reduce his taxable income by thousands of dollars in the case of pre-tax contributions. If he sets up the plan after December 31st of 2025, that is, he doesn't set up a solo 401k plan until January 1st of 2026. But by September 15 of 2026, if he files a timely business tax return extension, he won't be able to make any employee contributions, but he will be able to make both voluntary after-tax solo 401k contributions as well as employer contributions. So those are items to understand. So that's very important. Looks like we got one more question here. I think we already answered this question here. Okay, well, that's it for today's solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this community. We'll be back here again in a few hours with more crucial content. Until then, have a good rest of the day.